Hello students, warm welcome to our Shadputa official YouTube channel. The topic which we are going to discuss today, that is internal rate of return. This topic is useful for the students of CMA Part 2, ACCA paper F9, uh, and all the students those are uh, pursuing the course of finance either for their master level studies or undergrads programs or for professional studies. Okay, so let's start. What is the expected accomplishments of today's session? What is the agenda of today's session? So first of all, we will talk about what is internal rate of return. Then we will talk about what is the decision rules, which project we are supposed to opt or which project we are not supposed to take. Then we will talk about how to calculate IRR. Then what is the relationship between NPV and IRR? And finally, we will look at the advantages of IRR method and disadvantages of IRR method. So first of all, what is internal rate of return? Internal rate of return is a cost of capital, is an interest rate at which uh, internal rate of return is an interest rate, is a cost of capital at which NPV is zero. So this is an interest rate at which NPV will be zero. That is called internal rate of return. Now, what is the decision rule? If we have mutually exclusive projects, in that case, we will opt the project with highest IRR. Let's assume we have three projects, project A, B, and C. Its IRR is 15%, its IRR is 10%, its IRR is 5%. In that case, project B will be opted because its IRR is highest. Then we have non-mutually exclusive projects. In that case, opt all the projects those have equal or higher IRR than prevailing market cost of capital or market interest rate, which is also called. So all the projects those have higher or equal IRR than the market interest rate will be accepted, because we have discussed that there is inverse relationship between cost of capital and NPV. If your market interest rate is 10% and your IRR is 20%, in that case, once your market interest rate will go up to 20%, then your project would be on break even. In that case, all the projects those have has positive NPV. So if one project IRR is 11%, here margin is for 1%, but it has positive NPV. There is a margin of 1% increase in cost of capital to bring the project into break even. So all the projects those have equal or higher IRR means at equal, that project don't have loss, it is at break even. So we have to opt all those projects. Then how to calculate IRR? To calculate IRR, we have formula which is called A plus A divided by A minus B times B minus A. and bracket closed. Here, A is a lower interest rate or cost of capital. Then capital A, it is NPV at lower interest rate. Then B, higher interest rate, and capital B, NPV at higher interest rate. You can denote it with another symbols, but the concept is first one is lower interest rate, then numerator is NPV at lower interest rate divided by NPV at lower interest rate minus NPV at higher interest rate times higher interest rate minus lower interest rate. That is the formula. This method is called linear interpolation method. Keep in mind, this method does not give you the accurate IRR. It gives the best nearest IRR. It gives the best nearest IRR. To calculate the accurate IRR, we should have to use the program of spreadsheet. Okay. Then this is the example. Here we have data of cash flows, discount factors, and we have calculated NPV at 20% discount factor. Then we increase the discount factor. Interest rate we have increased from 20% to 25%, and we calculated the NPV. Here it is negative minus 7820. Here it is positive 1420. So we required two NPVs. It's not necessary that one should be positive, one should be negative. One at lower interest rate and one at higher interest rate. We use these two NPVs. Okay. Now, we have put the data in formula. This is lower interest rate, which is 20%. NPV at lower interest rate, which is 1427, divided by NPV at lower interest rate minus NPV at higher interest rate, which is minus 7820, times higher interest rate, which is 20%, minus lower interest rate, which is, higher interest rate is 25%, minus lower interest rate, which is 20%. So we have calculated, and our answer is 20.77%. So by calculating this formula, we calculate the answer, which is 20.77%. So what I did that uh, that I used another discount factor to calculate NPV, which is 10%. And here NPV is 25,330. Now, I have calculated for the verification the NPV at the IRR rate, which is 20.77%. Here we got 98% figure. So that is the proof that by using linear interpolation, we will get the nearest figure. It's not accurate IRR. So in your exam, you will use the word approximate, or if you have options, say option A, B, C, and D, then you will go to the nearest option. Okay. Now, this is the calculation about uh, graphic. Now, this is the graphical representation of IRR. On our x-axis, we will put cost of capital. I have used three cost of capitals, which is 10%, 20%, and 25%. And on y-axis, it's NPV figure. So at 10%, our NPV is 25,330 here. At 20%, our NPV is 1427, and at 25%, it's minus 7820 here. Now, where your graph will intersect with cost of capital x-axis, that is the point where your NPV is 0 and relevant cost of capital is your IRR, which is above the 20% but below the 25%, and it's approximate 22 point something, and this is the IRR point. This is the graphical presentation of your IRR data. Okay, now what is the relationship between NPV and IRR? Here, first of all, we are supposed to learn what is crossover rate. It is a cost of capital at which NPV of two projects is same. Say we have project A, project B at 10%, project A have different NPV and project B have different NPV, but at 15%, both have same, at 20% they have different. So the cost of capital at which NPV of two projects is same is called crossover rate. Then if cost of capital which you are using to calculate your NPV is higher than your crossover rate, in that way the recommendations of NPV and IRR would be for the same project. There would be no contradiction. But the cost of capital which you are using to calculate your NPV is different, is lower than your crossover rate. In that case, the recommendations would be different from both methods, and in that case, NPV method recommendation would be preferred as compared to IRR method. Okay. Now, what are the advantages of IRR method? It considers the time value of money. Okay. It is based on cash flows rather than profits. Those can be manipulated through creative accounting. It considers the whole life of the project. Yes, it considers. It leads to the wealth maximization, and it is relative measure. It can be used for comparison purpose. Keep in mind, I have discussed in my earlier lecture that in most of the cases, your advantages are same for different methods. So its first four advantages are same, those are for the NPV, and the last one is the additional advantage of IRR. Again, there is a typo mistake, sorry, it should be disadvantages of IRR. It is difficult to explain to managers. It requires the knowledge of cost of capital. It is difficult to understand. Its accuracy will depend upon assumptions about cash flows. These are the demerits used for all. This is the demerit used for all cash-based capital budgeting techniques. If you have non-conventional cash flows, in that case, you may have multiple IRRs and over there interpolation method cannot be used. What is meaning by non-conventional cash flows? Conventional cash flows are cash flows where at year 0 you have cash outflow and later on you have net cash inflows like we have used in this example. And non-conventional cash flows happens when in your later time periods, either in year 2, 3, 4, or in any year, you have net negative cash flow, means you have cash outflows, then those are called non-conventional cash flows and you have multiple IRRs. For that purpose, we are supposed to calculate modified IRR. Over there, interpolation method cannot be used. Then to calculate accurate IRR, as I discussed earlier, we need spreadsheet program. It means we must have to be a good knowledge of MS Excel. Interpolation method only gives you the estimated IRR. It will never be exact IRR. Thank you very much, you guys. I hope you may have enjoyed the lecture.